So to repeat again, the bondholders will get entire cash flow of the firm if the firm generates less cash than $450 million. If the firm generates cash flows exceeding $450 million, the bondholders will receive this $450 million as they are entitled only to interest and principal. This payoff graph is shared below here. There's a cash flow to bondholders of Banzai company as a function of cash flow to the firm. So in the horizontal axis, we have cash flow to the firm, total cash flows, and in the vertical axis, we have cash flows to bondholders. Actually, this is the payoff to bondholders, and bondholders being the call option sellers or writers. Again, you will remember this graph from the previous discussions throughout the chapter, and the exercise price being $450 million. Actually, here we have this graph. The bondholders can be viewed as owning the firm but writing a call option on the firm to the stockholders as well. If the cash flows of the firm exceed $450 million, the call is exercised against the bondholders, and bondholders give up the firm and receive $450 million, as was depicted by the graph here. And if the cash flows are less than $450 million, the call expires. The bondholders receive the cash flows of the firm. In this case, for example, if the cash flow is $300 million, this is the cash flow to the firm in its entirety. The cash flow of the bondholders will be this $300 million because they will be receiving everything in that case. So the stockholders have a call option on the firm, and the bondholders' position is as follows. First, they own the firm, and secondly, they have written a call on the firm with an exercise price of $450 million. As was mentioned before, the stockholders walk away from the firm if cash flows are less than $450 million, and the bondholders keep the ownership in this scenario. Nevertheless, if the cash flows are greater than $450 million, the stockholders exercise the option, calling the stock away from the bondholders for $450 million. What would happen if the firm were expressed in terms of put options? The same scenario can be animated through the use of put options. So the stockholders' position will be as follows. First, they own the firm and they owe $450 million in interest and principal to the bondholders. Again, the exercise price of the put will be $450 million. If the debt had been risk-free, these two claims would have sufficed to reflect the position of the stockholders. However, because the debt is not risk-free and a default on the debt is possible, there should be a third claim. The stockholders own a put option on the firm with an exercise price of $450 million. So the bondholders will be the seller or writer of the put. So there are two possibilities. Event 1, cash flow is less than $450 million as the put has an exercise price of $450 million. The put is in the money. The stockholders will put or sell the firm to the bondholders. Under normal conditions, the holder of the put will receive the exercise price when the asset is sold. However, the stockholders already need to pay bondholders $450 million. So this debt of $450 million will be canceled, and no money changes hands while the stock is being delivered to the bondholders. Because the stockholders give up the stock in exchange for extinguishing the debt, the stockholders end up with nothing if the cash flow is below $450 million. Event 2, cash flow is greater than $450 million. In that case, the put will be out of the money, causing the stockholders not to exercise. The stockholders keep the ownership of the firm, paying $450 million to the bondholders as interest and principal. Now let us look at the position of bondholders. They have two claims. Bondholders are owed $450 million and they have sold a put option on the firm to the stockholders with an exercise price of $450 million. The scenarios will be the same as those for the stockholders. So event 1, cash flow is less than $450 million. As was previously mentioned, the stockholders will exercise the put, forcing the bondholders to pay $450 million for the firm. Nonetheless, these two obligations will nullify each other because bondholders are owed $450 million. So in the end, the bondholders will own the firm. Event 2, cash flow is greater than $450 million. The stockholders will not exercise the put, and bondholders will get the $450 million owed to them. The stockholders continue to retain the firm. Recall that bondholders would have received $450 million in all scenarios if they had owned a riskless, default-free bond. The risky bond can be expressed in terms of a riskless bond and a put. So value of a risky bond equal to value of default-free bond minus value of the put option. So in that case, based on this equation actually, value of the default-free bond is higher than the value of the risky bond by the value of the put option. Actually, intuitively, this should make sense because for a default-free bond, the debtors or the bondholders will receive the value at all costs, regardless of what happens to the firm. But for the risky bond, there's a possibility that you may not be paid in full. So the value of the risky bond is the value of the default-free bond minus the value of the stockholder's option to sell the company for $450 million. Now we will try to reconcile these two approaches. So the positions of the stockholders and bondholders can be expressed in terms of either calls or puts. While it is easier and more intuitive to internalize the scenario through calls than that through puts, these two approaches are equivalent. The positions of stockholders and bondholders in Banzai Company in terms of calls and puts. Stockholders, bondholders, stockholders on the left and bondholders on the right. The positions viewed in terms of call options. First, if it were a call option, stockholders own a call on the firm with an exercise price of $450 million. And for bondholders, they own the firm and they have written or sold a call on the firm to the stockholders. If it were a put option, then stockholders will own the firm. Stockholders owe $450 million in interest and principal to bondholders. And additionally, stockholders own a put option on the firm with an exercise price of $450 million. And for the bondholders, they are owed $450 million in interest and principal, and they have sold a put on the firm to the stockholders. So here, the put-call parity will help us understand this equilibrium.